Welcome to the Sand to Pearls Stock Market Commentary for market week ending Friday, July 11th, 2014. Market breadth. With this past week's market advance, our bull-bear point and figure ratio fell from 2.39 to 1.44, still in bullish territory. The total count of securities in bullish or bearish patterns fell 3% to 2,091. The count of bearish stocks increased 34%, while the count of stocks in bullish patterns decreased 19%. The Sand to Pearls P&F Market Breadth Summary Chart shows us a market now 8 consecutive weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking on Membership, and clicking Sign Up. For those who are interested, a free 2-week trial subscription is available. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 136 points for the first decline in 8 weeks. At a positive 181.48 points, it has fallen below the November 2011 top and continues below all 7 other tops above plus 100 and above all 6 bottoms below minus 100 in the last 35 months. Market Gauge Volume Analysis. In this week's volume analysis, the Russell 2000 ended in distribution mode. In the last 2 weeks, it had 4 accumulation days and 3 distribution days. Of the other indexes, both the Diamonds Trust and the S&P 500 deposit receipts ended in distribution mode. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Russell 2000 ended in neither accumulation nor distribution mode. Momentum. At Friday, 7/11 close, the CCI 20 daily gave a valid zero-line reject long entry signal within the plus or minus 50 range. We will follow the results of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 1 week ago, while the daily CCI 20 began a Woody's uptrend 6 weeks ago. The CCI 20 weekly continues above plus 100 after having shifted to an uptrend per Woody's rules last week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish computer hardware continues in the top 5. Semis has entered the top 5. REITs has left the bottom 5. Oil continues in the bottom 5. Oil services has entered the bottom 5. Bearish brokers has entered the bottom 5. Gold and silver continues in and now leads the top 5. Disk drives has left the top 5. Focus this week. From Investors Business Daily Twitter, the big picture. The week's action was the worst in 3 months, as measured by distribution dollars. Could it be that now even small investors more or less intuitively have figured out the same thing JPMorgan has? From www.zerohedge.com, JPMorgan blows up the Fed's "we can control the crash with Reverse-Repo" plan. A few points from the article. Various strategists wrote thinly veiled attempts to calm market concerns that the repo market, the glue that holds risk assets together, was FUBAR, Even the Fed itself sent missives opining that their cunning reverse-repo facility would solve the problems, and everyone should go back to the important business of BTFATHing. As JPMorgan warns, not some tinfoil hat-wearing blogger with an axe to grind, quote, the Fed's reverse repo facility does little to alleviate the UST scarcity induced by the Federal Reserve's QE programs, coupled with a declining government deficit, end quote. The end result, they note, is, quote, higher susceptibility of the repo market to collateral shortages, end quote, and thus dramatically higher financial fragility, the opposite of what the Fed hopes for. The reverse repo facility has been growing rapidly, but at between $100 billion to $200 billion currently is rather small compared to the $2.6 trillion of excess reserves in the liability side of the Fed's balance sheet, or the $4 trillion of securities in the asset side, $2.4 trillion of which are USTs. The Fed has little appetite to allow the reverse repo facility to grow very high levels eventually. Without collateral to fund repo, there is no repo. Without repo, there is no leverage positioning in financial markets. Without leverage and the constant hypothecation, there is nothing to maintain the stock market's exuberance, as we are already seeing in JPY and bonds. This stock market commentary is respectfully submitted by Donald Pearl, www.s2pmarketsignal.com. Thank you for tuning in for this week's Santu Pearls stock market commentary. Hoping that you are enjoying a great weekend, that you have a wonderful week coming up, and wishing you true success.